All right, so quick survey. Does anybody have a class after this one on Fridays? All right, so I stand between you all and the weekend is basically what you're saying. It's a responsibility I take very seriously, and I try not to betray your trust on that. So we're going to start chapter 3 today, and we'll wrap up chapter 3 on Monday. So please note, Monday, there is a discussion assignment for Monday. It is on Brightspace. You do not need to submit anything. I just put it on Brightspace as a reminder that we'll be talking about it. Please come to class prepared to talk about it, though. As far as real quick on an announcement on that I've had some students reach out to me with issues and idea. We're trying to still work with that, but I did want to say thank you very much for making me aware of these things. As I said, the most important thing in this class is that you notify me when an issue arises. And so far, we're off on the right foot, if not necessarily on the right technology foot. But please make sure if you run into any issues or you run into problems that you make me aware of them as early as possible so that we can try to address them. This unfortunately has come up in the past, and we'll try to address this as we can moving forward. For those of you who were able to complete the first idea assignment without any problem, kudos to you all. You dodged a bullet apparently. Anyway. Let's go ahead and let's talk a little bit about engagement, continuation, and acceptance and some issues associated with that. So the very first thing we have to note is that auditors don't exist in a vacuum. They don't show up at a client site and say, all right, we're here to audit. Auditors are just a business like anybody else. They have to go out and they've got to find people to do work for. And there's a lot of demand for it, but that doesn't mean that there's still not a need to sell the business. Now, auditors are unique in the fact that they work for the client, but they're also scrutinizing the client. So there's some pretty rigid standards that we have to follow in our responsibility whenever we consider whether we're going to work for a new client. So the first situation we're going to talk about is we're going to talk about prospective client acceptance. And this basically means that we have not worked for this client before. We're going to be going into this client for the first time, and we need to make a determination of whether or not we want to actually take this individual or this entity on as a client. So before accepting a new client, an accounting firm should determine the following. First of all, that it is capable of performing the engagement. Now, this probably seems like it's pretty straightforward, but to think about this in context is that audits do not come in one shape and size. They come in many shape and sizes. An audit of my favorite local restaurant, Greek Corner Gyros, is going to be a lot different than an audit of Amazon.com. I still call it Amazon.com. I know they're just Amazon now. Sorry, guys. I need to get with the 21st century, I guess. Anyway, much different in scale and scope. An auditor who could actually handle the Greek Corner Gyros audit probably would not be well inclined to handle the Amazon audit. So we need to first of all determine, do we have the capability and resources necessary to do the job? Second thing we have to consider is whether the keyboard will work. Okay, do we comply with legal and relevant ethical requirements? And one of the primary issues we're going to think about here is, do we meet the criteria of the Code of Professional Conduct? We talked a little bit about that on Wednesday. One of our primary criteria in this area is going to be independence. If I own part of a client, if I have stock ownership of a client, I can't be the auditor for that client. That's a violation of the independence rule. So we need to make sure that we meet those criteria and that that both the client and the auditor are meeting the legal criteria and the ethical criteria in their respective areas. Then finally, we need to consider the integrity of the client. Now, keep in mind as we move through this, we need to be very, very aware that we're in a classroom environment, and classroom environments tend to be very, very sanitized. And what I mean by that is students say, if there's a problem, all right, there's a problem, we got to panic, all right? With respect to an audit, we're never going to have a perfect client. We're never going to go in where the client reports everything as on time and everything as planned. They're never going to have every single person is a perfect law-abiding citizen that has never had a drink of alcohol, that has never gambled. It's just not the way that the world works. So some integrity lapses to be expected, but if we've got a management that's consistently and problematically misreporting their financial position to their stakeholders, this is probably an audit we don't want to take on. So we do need to consider whether or not we can trust what management represents, because remember, that's what we're testing. We're ultimately testing management's assertions regarding the financial statements. All right, so what about if The auditor, their prospective client has been previously audited. What are we going to do? Well, we've got a resource that we can rely on, and that's the predecessor auditor, the previous auditor. We can actually talk to them and say, we need some information before we make our decision about whether we want to be the auditor moving forward. So what are some things we're going to talk about? Well, we just talked about management integrity. We want to make sure management's honest. We want to know any disagreements with management that the predecessor auditor had. So the previous auditor disagreed with management, and they want to know what is the nature of these disagreements and did it affect your audit opinion? Communications with corporate governance. All right, communications with corporate governance. This is generally going to be one of two bodies. We talked about this on Wednesday, the board of directors, or more primarily, if there exists, the audit committee. And we're going to talk a little bit about the audit committee shortly because they're a very important body with respect to auditing. We also want to know the reason for the change in auditor. Now, keep in mind, this can be many different reasons. It could be nefarious. It could be that the predecessor auditor refused to work with the client and they refused to misstate the financials. And so they got rid of him and trying to hire an auditor who's going to basically meet their requirements. If that's the case, we probably don't want to join the new engagement. We probably don't want to accept this new client. But what about a situation where the client has experienced massive growth over the past few years and the predecessor auditor is too small to be able to handle such a large client? That would be a legitimate reason for a change in auditor, that we would need an auditor that could handle, they would need an auditor that can handle a much larger client. So there are legitimate reasons for changing auditors. And in fact, I'd say most of the situations that we encounter are legitimate reasons. And then related parties and unusual transactions. Now, we'll talk about related party transactions here in just a little bit, what those entail. These are something we have to be aware of as they are subject to reporting requirements under generally accepted accounting principles, and we have responsibilities for those under generally accepted auditing standards. All right, so those are kind of the guidelines for client acceptance, but what about client continuation? We have been the auditor for a client for at least 1 year. What kind of things do we need to think about if we want to continue auditing a client? Well, the first thing, we're going to evaluate client retention periodically. This usually occurs after an audit, but before the start of the new audit. So we immediately complete the previous audit. And we say, are we going to continue on with this client for the following year? And so this occurs pretty early in the process, near the end of near audit completion or after a significant event. If something occurs that changes our perspective, like a subsequent event or like a disposal or a purchase, an acquisition, any one of those being things that changes the nature of the client. What are some reasons that we as an auditor might decide we do not want to continue auditing this client? Well, probably the most common reason is going to be if there are frequent conflicts over accounting and auditing issues. Keep in mind, our job as auditors is to make sure that the client or the management of the client is properly representing their financial position. If they are doing that if they're making things difficult, if they're creating problems in this area, if they're misstating their position frequently, that is a hardship on us. And keep in mind that as auditors, we are liable for any misrepresentations. So just if we are doing the audit, we are making a representation. Remember that opinion that we talked about on Wednesday? We're making that opinion saying we think the financial statements are free from material misstatement. If we're wrong about that, we can be punished. We can be sued. You know, the SEC and the PCOB can reach out and say, slap your hand, you know, that you did a bad job, and slap your hand usually costs a lot of money. All right. So we are liable for that. So we want to be very, very clear that this does not exist, that there's not those frequent conflicts, because if they do exist, it creates problems for us as auditors. The other one is going to be disputes over fees. And this is basically saying we have to charge a client a certain amount because we have to pay our employees. If the client's not willing to pay that amount, we can't do our job effectively. It's a little bit like saying when you go out into the real world and you say, I'm looking for a job, and somebody tells you, okay, I've got a great job for you. I'll hire you on. And say, how much is it? I'll give you $5 an hour. Okay. I'm hoping most people in this room are not going to say, that sounds great. Okay. That is a bad deal. Don't accept a $5 an hour. Minimum $5.15 an hour. Okay. You all are worth more than $5 an hour. Anyway, yeah. So if we are not getting paid sufficiently, we can't pay our employees and we can't do the job effectively. There's requirements in that regard. So that can be an issue as well. But let's assume that we are going to move forward with the engagement, whether it's a new engagement or an ongoing engagement. We have to make that assumption, by the way, because if we don't make that assumption, we have nothing to audit. Okay, and we're just going to sit around the rest of the semester staring at one another. All right, which is really, really awkward. It's really, I did that one semester. Students didn't learn much. Anyway, I've never done that. No. Anyway, we're going to continue on with the audit. So what are some things that we have to do? Well, first thing is we need to determine the audit engagement team requirements. So how many people do we need on the team? Do we need any specialized help in this area? Is it an area of industry that is got specialized accounting rules or even specialized auditing rules that we need to be aware of? If the answer is yes, then we have to actually make adjustments to our engagement team as necessary. If it's a large client, we may need a massive engagement team. We have to figure out all of these details. Additionally, we have to ensure compliance with ethical and independence requirements. And this goes back to that code of professional conduct I was talking about. But there's some really weird rules that exist in this area that we need to be aware of. For example, did you know that if you have unpaid audit fees by a client that are over a year old, you can't be the auditor for that client? Can anybody guess why that's the case? So back in 303 with the recently departed Dr. Shoniwa, okay, the late Dr. Shoniwa, remember you all learned about payables, and to say if you have a current payable that's over a year old, what does it become? A long-term payable, note payable. And what's associated with a notes payable? Even if it's not stated, you have to impute what? Impute also starts the letter I. Interest, you have to impute interest on it, okay? So if you have interest on an instrument, you are technically considered to be an owner, okay? Because you have an ownership stake in a company. So if you've got outstanding fees from a client that are over a year old, that's a long-term payable, which means that you're part owner, which means you violate independence rules. Really weird, huh? Really weird, but that's the way accounting works, okay? So also, there's some rules regarding consulting services here. We talked a little bit about that on Wednesday. Keep in mind that we're very concerned about anything that might compromise the integrity of the client-auditor relationship. So a lot of times auditors cannot perform additional services other than auditing. We also need to establish and understand with the entity. This primarily consists of 3 parts. We need to develop the engagement letter. We need to understand if we can use the work of the internal audit function. And we need to know the role of the audit committee, which we're going to talk about each of those in turn. All right, so let's talk about this first thing. It's called the engagement letter. And when I say the engagement letter, obviously I'm referring to this right here. Oops, that right there, okay? Isn't that beautiful? When it happens, it's just such a joy. But that's not the type of engagement we're talking about here. So an engagement letter is a contract between the auditor and the client that details the work the auditor is going to perform. There are lots of different possible pieces of information that can be included here, but every engagement letter will contain generally 3 parts, or should contain 3 parts. The first of these is going to be the objective of the audit. Second of these is going to be what is management's responsibility. And the third of these is what is the auditor responsibility. So let me repeat that just to make sure everybody got that down. Okay, the objective of the audit, management's responsibility, and auditor's responsibility. Now, this is probably the first point we need to point out, that management's responsibility and auditor's responsibility are very distinct, but it's not obvious what they are. So what is management responsible for? Can we say that it's fair that say that management is responsible for the design and publishing or aggregating and publishing the financial statements? Yes, that's part of their responsibility, because remember, they've got to report to external stakeholders, and those financial statements are part of that. So financial statements, responsibility of management. Also, those things called internal controls. Can we say it's fair that management is responsible for the design, implementation, and maintenance of internal controls? Yes. So the creation of these things, that's a responsibility of management. What does the auditor do? The auditor evaluates these things. So that's an important distinction to make. If we talk about auditors' responsibility for financial statements, they have no responsibility for creation. They did not create internal controls. They are only there to evaluate whether or not these are operating effectively or designed effectively. All right, moving forward. So we have this thing called the internal audit function. So internal auditors, we referred to those back on Wednesday, and I said internal auditors are auditors who work for the client. And they do a multitude of different functions, but a lot of these have to do with the maintenance of things that management implements, such as controls or publishing of the financial statements. It would be wonderful if we as the external auditors could take the work that the internal audit function does and use that as part of our testing, okay? So think about this from your own perspective. Say that you're really, really stressed out and you've got some problems and you're just kind of like, okay, I've got this project due in Excel that I've got to put together and it's massive and I have no basis for creation. And then a friend of you says, friend of yours says, you know what, I've got a template that I use for this project. The Dr. Otero said it was okay to share. I don't know why I picked Dr. Otero here. If I'm thinking massive projects, that's the default I go to, I guess. Anyway, so Dr. Otero said it was okay to share. Would you want to use that template? Yeah, it would have cut a lot of time off the work of what you had to do. But you do need to check some things because depending on your friend, if it was a friend like anyone here at Truman State, you probably can rely on them. If it was a friend like me, be like, I don't know the quality of your work is suspect, Dr. Barnes, you know. Anyway, yeah, you'd want to check and make sure that that work is going to be useful. We have to do the same thing as auditors. We would love to rely on the work of the internal audit function, but we have to evaluate whether the work can be relied upon. There are 3 criteria for that. First of all, we have to note the extent to which the internal audit function's organizational status and relevant policies and procedures support the objectivity of the internal auditors. So if I were to say that you are objective about an issue, would that mean that you have independence issues or that you are free from bias? Objectivity implies a freedom from bias, correct? So you're objective. You look at it and you say, okay, I'm going to evaluate this thing. I don't have any bias. That's one thing that we're concerned about here. Is the internal audit function free from bias? If they are objective, that's our first criteria. Secondly, the level of competence of the internal audit function. Obviously, in order to rely on their work, we want to make sure it was done competently, that it was done correctly and accurately. They did their job well. And then finally, we have this thing called the application by the internal audit function of a systematic and disciplined approach, including quality control. In other words, does what they did make sense? It could be correct, but if you can't follow the process, then you can't really rely on the work. So we need to make sure that they followed an approach that we understand. I'm going to break this down into 3 little boxes that are a little bit easier to follow. So these are 3 criteria for the internal audit function: objectivity, competence, and a systematic and disciplined approach. Those are the words that you need to hold on to. All right. So internal audit functions down, engagement letters down. Let's talk about the audit committee. All right. So the audit committee is a subcommittee of the board of directors. And we're going to talk about their composition here in just a second because there are some interesting requirements in this area. It's important to note that if we're dealing with a privately held company, this is a non-issuer company, somebody who does not file on an exchange here in the United States, there's no specific requirements here. We don't have to follow any of the rules I'm about to tell you. This is just for private company auditors, okay? So private company auditors, not subject to any of the rules we're about to talk about. These are exclusive to public companies, companies that are public and that are audited by public company auditors, okay? So PCAOB rules is what we're going to deal with now. For publicly traded companies, however, SOX 301 deals states the specific requirements and responsibilities for audit committee members in publicly traded companies. So that the wording that's used is outside independent board members. And to prove that I'm correct, I actually remembered this year or this semester to bring up the Sarbanes-Oxley Act. Remember, I provided you all with a copy of the Sarbanes-Oxley Act in Brightspace because every accountant should have a copy of the Sarbanes-Oxley Act. So what does it say here? It says, in general, each member of the audit committee of the issuer shall be a member of the board of directors of the issuer and shall otherwise be independent, okay? So what does it mean about independence is it cannot accept any consulting, advisory, or other compensatory fee from the issuer, okay, other than being a part of the board of committee. And it cannot be an affiliated person of the issuer or any subsidiary thereof. Now that one's probably the most important point. When we say that cannot be an affiliated person of the issuer or subsidiary thereof, what does that imply? If I said that they cannot be an executive or they cannot be a manager, would that make sense? Probably so. So anybody who's on the audit committee, they have to be independent they have to be outside and independent with regard to the fact that they cannot be a member of the executive team for the company. They cannot be part of management. So the audit committee has to be outside and independent in that regard. But there's something else that I want to go back to, okay? So something else. It says, additionally, SOX 407 requires that at least one member of the audit committee be a financial expert. So what does that mean? Well, let's go back to our handy dandy Sarbanes-Oxley Act and move forward to page 46. So this is somebody with an understanding of generally accepted accounting principles and financial statements. So the good news is that meets everybody in this room. We're all experts at GAAP, right? It says nod your head. Don't shake your head at me. Okay. You're all experts at GAAP. It's like kiss. All right. And they have experience in the preparation of auditing financial statements of the comparable issues and the application of such principles in connection with the accounting of estimates and accruals, reserves, and controls, and understanding of the committee functions. Okay. So basically what they're saying there is that you have to have been in a position where you prepared financial statements that were audited by an auditor. Unfortunately, nobody in this room meets that criteria, not even me. I have audited, but I've never prepared financial statements that were used in conjunction with an audit. So that's going to be the rule for financial experts. Now, it's important to note, there is a requirement that financial expertise exists on an audit committee, which makes sense. We probably don't want an audit committee. It's like, I don't know what a financial statement is. I don't even know what numbers are. That would be silly, okay? But it only has to be one individual in the audit committee that possesses this knowledge. They're going to guide the audit committee. So it is a little bit laid back, but it does require that at least one person have the requisite knowledge in this area, and it's a pretty specific set of criteria. All right, so as far as planning goes, audit strategy, this is what helps the auditor determine what resources are needed to perform the engagement. When we get down to more detail, we got the plan. This is basically going to consider how to conduct the engagement in an efficient manner. What is involved in the audit strategy and plan? Well, steps in audit planning are going to be assessing business risks, which we'll talk about more in detail in chapter 4. Then we're going to establish materiality, which is going to be our subject for next Monday, when we talk about materiality specifically. Consider multi-locations. This is basically a function of large clients who may have multiple locations that are relevant to an audit. How do we audit multiple places, have multiple physical locations? For some place like Walmart, which literally has thousands of stores, you may have to have a really, really large audit team. In fact, you may have to have multiple audit teams. We want to assess the need for specialists based on the nature of the industry and the client. We also want to consider violations of laws and regulations, okay? We generally term these as illegal acts. So anything that's against the law. What is an auditor's responsibility there? Well, I'm glad that everybody asked. I know that you were ravenous for this answer, okay? The auditor has a responsibility to plan the audit and provide reasonable assurance of detecting illegal acts that have a direct and material effect on the financial statements. So direct and material effect is the really important terminology there. If the client breaks the law, we need to know that it directly affects the financial statements in some way, and that amount that affects the financial statements has to be material in nature. If it's like one of the engagement team went down to one of the Walmarts nearby and stole a pack of gum, well, that's breaking the law, yes, but that's not something we would be responsible for as auditors to detect, okay? Has to be something substantial and that we can point specifically to where in the financial statements is affected by it. We also want to identify related parties, which I'm going to talk about here in just a second. We also want to consider value-added services. Now, this is something that we have some scrutiny problems with simply because value-added services generally imply other types of engagements. But remember earlier in this lecture and on Wednesday, I said, auditors generally can't produce other engagement types. They really generally can't perform other types of engagements because that violates independence. So we have to be very, very careful about the types of engagements that we engage in with our clients. Then we want to document the overall audit strategy, audit plan, and prepare audit programs, which is part of our documentation discussion we will get to in chapter 5. All right, related party time. What is a related party? What does it sound like? Somebody with a relationship with the client, whether that actually be a physical relationship, you know, like son, daughter, aunt, uncle, whatever, might be a familiar relationship, or maybe a pre-existing working relationship. So one of the problems that we identify with related party transactions is they may not be at arm's length. And if the reason I use that term at arm's length is that's the vernacular that's used to describe non-related party transactions. And why is that term used? Well, let's just think about this. Let's say that you engage in a transaction with a party that you are not familiar with. Say that you're going to sell somebody something on online, and you engage in a transaction, and you commence the transaction, you meet up, and you finish the transaction, and you agree upon it. What are you going to do at the end of the transaction? Going to shake hands, say, thank you very much. We did great work. Thank you very much for your business. That is at arm's length. Okay, that is why they meet at arm's length. Think about this differently. Let's say that you say you're going to sell your bike to a family member, and you say, I'm going to sell it to you for $1. They're going to say, thanks, that's such a good deal. I really needed a bike. Okay, are they going to shake your hand? I mean, no judgment if that's the way your family operates, okay? But most families, if you're gonna have like a family member, you sell your bike to your mother, it's gonna be kind of like, thanks, mom, as our mom's, and you're gonna give her a big hug. We can argue that that's closer than an arm's length transaction. Can we make that argument? That's something that's pretty reasonable, okay? So arm's length transaction is kind of a physical representation of the implication of related party transactions versus non-related party transactions. Now, from a GAAP perspective, from generally accepted accounting principles, any related party transactions have to be disclosed, have to be evaluated and disclosed in the financial statements. What do we have a responsibility as for auditors? Well, the first thing is we need to obtain an understanding of these relationships and transactions, and we need to make sure that these transactions have been properly evaluated and disclosed. We have to make sure that the client is following GAAP rules. If they fail to do so, that is a violation of generally accepted accounting principles. Now, I want to make a note here because there's always often a lot of confusion, because when we hear related party transactions, everybody's like, oh, those are bad, should not exist, get rid of them. Related party transactions are not illegal, okay? They are not illegal. They are just heavily scrutinized, and we as auditors have a responsibility to perform that scrutiny, okay? We need to make sure that at best possibility, they represent an arm's length transaction. If they don't, then we need to make sure stakeholders, anybody who uses the financial statements, is aware of those implications. It's like every single other client that we deal with, or that our client, or every single customer that our client deals with pays $10 per item for this. But the son of the client making a purchase for $2 per item. We can make an argument that is a related party transaction that is not an arm's length because they got preferable terms. All right. Last slide that I want to go into is I want to talk a little bit about the phases in audit testing, because these will be relevant as we move forward. So the very first thing I want to tell you, and this is going to come up multiple times throughout this course, particularly as it relates to this chapter and chapter 4. Questions will arise as to what type of procedures you're performing. And oftentimes these questions relate to what phase of the audit are you in? So right now where we're at, this is basically our second lecture. We are in the very first phase of the audit, which is considered to be the planning phase. So engagement, acceptance, and continuation, and we're making our initial planning decisions. At this point, we're not doing any testing. We're not collecting any evidence. We are just making very, very preliminary assumptions. When we get to chapter 4, we will still be quote unquote in the planning phase, but we'll move over to something called risk assessment. Risk assessment is where we start making determinations about how we're going to approach the audit based on what risks we believe exists. After that, we're going to test controls, and then we're going to move to substantive procedures. Now, the reason that I bring this up is because it's really important to understand what type of work is performed during each phase of the audit. And hopefully we'll have enough reinforcement and rigor over this that everybody will be sick of this by the time the audit is. Like at that, if we're at the end of the semester, be like, don't repeat this again, Dr. Barnes. I've accomplished my job, okay? But if you still need to be repeated at the end of the semester, then that's where we have problems. So we're right now in planning phase, and the only thing we can do is things that are related to planning, okay? These things that we talked about right over here, a lot of this stuff right here, plus some other things that would do with respect to the strategy. Once we start moving forward, that's when we start making more critical evaluations related to the financial statements and the client itself. It's important to note, we'll talk a lot more in detail about this, but substantive procedures contain two subphases. They contain something called substantive analytical procedures, which is basically creating fancy models to try to make predictions about the way things behave, and substantive tested details, which is basically our wrap-up work. Also, certain procedures can be used for both tested controls and substantive tested details. Such procedures are referred to as dual-purpose tests. We'll probably not look at a lot of dual-purpose tests in this course, but you may encounter that term through your reading and through your review. So if you do that, if you see the term dual-purpose test, that's basically what we're saying, is it's a test that actually gains assurance right here and right here simultaneously. And with that, we are done with this part of the lecture, but we still have homework to go over. So let's go ahead and do that. Okay. So just a few multiple choice questions. This is just kind of an introduction, but as a reminder, for all your multiple choice questions, not only do you have to answer the question, but you have to provide a rationale for your answer. So let's make sure we can do that. So first question is 113. An independent audit adds value to the communication of financial information because the audit does what? Well, let's go ahead and let's work through each of the answers and see if we can come up with an answer. And I will do this for many questions, not every single one, but I do think that early on, this is a valuable process. Confirms the exact accuracy of management's financial representations. Is that a correct statement? What is the problem? What is the problematic word in that statement? Exact accuracy. Exact is probably the word, exact accuracy. Because remember, we said we can't provide absolute assurance. That's impossible. So exact accuracy implies absolute assurance. So we can't keep that. What about lends credibility to the financial statements? Well, that kind of meets what we talked about. Because remember, we talked about the principal agent relationship. The agent provides the financial statements, said these are right. We as auditors are going to go in and say, all right, test. Yep, they're correct. Those are right. So that sure sounds like lends credibility. So B sounds like a good answer, but let's go through the rest. Guarantees that financial statements are fairly presented. That guarantee word is probably problematic. So you should never use absolutes. Never. Usually gets a bigger laugh. Anyway, yeah. So absolute statements are really problematic, and guarantee is certainly problematic because that implies absolute assurance. Assures the reader of financial statements that any fraudulent activity has been corrected. Are we trying to capture all fraudulent activity? No. In fact, we talked about that just a little while ago. If it's an illegal act, it's just that the illegal acts that have a direct and material effect. 114. Which of the following best describes the reason why an independent auditor is often retained to report on financial statements? Okay. So management fraud may exist and it's more likely to be detected by an independent auditor than by internal auditors. All right. So just intuitively, does that statement make sense? Management fraud may exist. That's a correct statement. But who do you think is more likely to capture it? Is it going to be the independent auditor or the internal auditor? Probably the people who are looking this on a daily basis, as opposed to the company or the group that comes in for a few weeks out of every year. So that seems like a non-intuitive statement. But what about different interests may exist? The entity preparing the financial statements, the person using the statements, and thus outside assurance is needed to enhance the credibility of statements. That sure sounds like a repetition of that lens credibility statement that we said before. That's in fact our answer. But let's go through the rest. A misstatement of account balances may exist, and all misstatements are generally corrected as a result of the independent auditor's work. So we have that absolute statement all again, which is problematic. What we're going to find, especially when we start talking on Monday, is that at some point we're going to say that difference does not matter. That's the basis of this idea of materiality. Materiality may say that if it's not a big enough difference, we don't care. All right. Entity may have poorly designed internal control system. If it's poorly designed, that's a responsibility of management. We as auditors can actually identify problems with that, but that's not our primary responsibility. It's usually that financial reporting that we talked about. All right. Which of the following best describes relationships among auditing, attest, and assurance services? So remember those ovals that we had back in chapter 1. Which one's the biggest oval? Assurance, okay? And the one in the middle, attest, and then auditing is a really, really specific sets of testing. So attest is a type of auditing service. Remember, auditing's in the middle. It's the other way around. Auditing would be an attest type of service. Auditing and attest service represent two distinctly different types of services. There is no overlap. Well, given that one circle is within the other, I'd say there's quite a bit of overlap, all right? Auditing is a type of assurance service. Yes, that falls within those ovals. Assurance is a type of attest service. No, again, flip to those. That would be correct. Okay, 118. By the way, this is one of those, these next two questions have information that's not funny unless you've been teaching auditing for like 9 years, okay? But then I find these questions hilarious. Which of the following statements best describes how materiality is related to the audit evidence in a financial statement audit, okay? And then A says, materiality refers to the material from which the audit evidence is developed. And I just personally find it hilarious. I know nobody else in this room does. You're just kind of like, you're such a dork, Dr. Barnes, yeah? And it's true, all right? But that's not the correct answer. So the answer is going to be some relationship between evidence and the amount. So the question though is this going to be B or C? The higher the level which auditor assesses materiality, the greater the amount of evidence the auditor must gather, or the lower the level, so on and so forth. So what do you guys think? Let's just take a quick informal poll. And then, by the way, there are no wrong answers except for the one that's the wrong answer, okay? So do you think it's B? Do you think it's C? All right, well, I'm going to go with C, but it's not intuitive as to why that's the case, okay? It's not intuitive as to why that's the case. Let's talk very quickly about how materiality works. So basically, the lower the materiality is, the more work that we have to do. and vice versa. Now, why is that the case? Why is that the case? Well, let's just go ahead and use a very simple example. Silly example, but again, all my examples are silly. You are at the end of the semester, you've done very well in the class, and you're going to take the last exam in the course. You need a 50% on the exam. So you've got a 50% range of scores that you can score and still get an A in the class. How much work do you have to do on that final exam studying? Relatively speaking, not as much as you would have had to know in previous ones, right? Okay, you've got a lot of wiggle room there. Okay, so that big range means that you have less work. Let's flip the situation. Let's say you have to get a 98% on the last exam of the semester in order to get an A in the class. So you have a 2% range that you have to score within. You have to get 98, 99, or 100. That's it. Okay. How much work do you have to do to make sure you fall within that 2% range? Absolute assurance levels type of work. That's the basically we're getting at. You're going to have to get basically every question right. So the smaller that range becomes, the more work you have to do. And that's the underlying theory behind materiality. All right. As materiality becomes smaller, we have to work harder. As materiality becomes larger, we have to work less. All right, 121, another one of these questions that I laugh at. Which of the following statements best describes what is meant by an unqualified opinion? So B says, an unqualified audit opinion says an auditor is not qualified to express an opinion, which again, I find that hilarious, okay? That's not our answer. What is our answer? Does anybody have a guess on this one? D, okay, an unqualified auditor's opinion indicates the auditor's opinion in the client financial statements are fairly presented in accordance with agreed upon criteria with the inclusion of no qualifying phrases. So the term unqualified is not immediately clear. It could actually be somebody reading this, somebody who had not been in this course for the first few classes and doesn't have any accounting experience might read this and say, this makes complete sense to me, Dr. Barnes. Why are you laughing so hard? All right. And I'd say the answer is because unqualified means there's no qualifications necessary. Everything is good. We don't have to add any additional language there. All right, 123. A client has used an inappropriate method of accounting for its pension liability on the balance sheet, which is certainly understandable because pensions are miserable. Dr. Shoneywood told me he doesn't even teach pensions in 303 anymore. Is that true? What a slacker. All right, I get to say that now he's gone, okay? I'm going to send him his video too. All right. The resulting misstatement is material, but the auditor does not consider it to be pervasive. The auditor is unable to convince the client after accounting treatment. The rest of the financial statements are presented fairly in the auditor's opinion. Which kind of audit report should the auditor issue in these circumstances? All right. So what kind of issue is this here? So can we agree that this is an issue? All right. Is it material? Is it pervasive? It's not. Okay. Now, before we talk about the type of opinion, let's talk about, is this a departure from GAAP or is this a scope limitation? Departure from GAAP, the client's not following the rules, okay? It's important to make the distinction. Scope limitation would basically say, we tried to do our job, we could not do our job, okay? So we have a departure from GAAP here that is material but not pervasive, meaning that we have a qualified opinion due to departure from GAAP, okay? Actually, you just say qualified opinion, it doesn't really matter what the reason is that we're looking for that. So how would we treat that in the report? We would basically say, except for this matter described right here in this question, the financial statements are free from material misstatement, okay? What are our opinion types, by the way, just reiterate. So we talked about the first one, which is clean opinion, that's called unqualified, or if we're talking about the ASB, it's called what? Unmodified. Then we have this issue here, which is the except for statement, which is qualified. Then we have a pervasive departure from GAAP, which is adverse good. And then we have a pervasive scope limitation, which is called disclaimer of opinion. Okay, disclaimer of opinion, which basically says we can't issue an opinion because we were not able to do our job. All right, good. Let's go over to chapter 2. All right, chapter 2 starts with number 19. Which of the following statements best describe management's and the external auditor's respective level of responsibility for public companies' financial statements? Okay, so I'm not going to go all of these because these are all long statements, but let's look at C and make sure we understand. Management has the primary responsibility to ensure that the company's financial statements are prepared in accordance with GAAP. Can we agree that that's correct? Hopefully so, because that's the answer I picked out as the correct one. So yeah. And the auditor provides reasonable assurance that the statements are free of material misstatement. So that reflects something that I said a little bit earlier in today's lecture. I said, management's responsible for the fair presentation of the financial statements and the design, implementation, and maintenance of internal controls. So they make sure that the stuff is created properly. We, as auditors, we test that to make sure that the controls are good and the financial statements are correct. That's our responsibility. So any iteration of that, including this statement right here in part C, is going to be a correct answer. And you'll see multiple variants of this particular type of question. All right. 221, the Public Company Accounting Oversight Board. What do you guys think? Quasi-governmental organization that has legal authority to set accounting standards for audits of public companies? That's A, and that sure sounds correct. Because remember, the PCAOB is exclusive to companies that are public. Now, I kind of glossed over this on Wednesday, went over it, but when I say public companies, I mean companies that publicly file in the United States, okay? And there are companies that are domiciled in the United States. Then there's an important distinction to make because there's a lot of confusion in this area. Usually when we talk about PCAOB companies, we're talking about companies domiciled in the United States that file on an American exchange. There are also some other criteria that we're not going to talk about just immediately. Now, if we're talking about a foreign organization that operates in the United States, they could actually operate under different auditing standards as long as they are acknowledged by the SEC as being appropriate. We are going to focus primarily on these public companies for our case here because they tend to be the largest and the most complex organizations. That does not mean that the rules for smaller companies, for non-issuer companies, are not important. It just means that they tend to be less stringent than the ones that we're going to talk about. So by learning about the big picture companies, we're going to learn a lot about the small picture companies or small range companies. All right, so going back to chapter 1, we have one question left, which has to do with a problem that we're reading. So you were recently hired by the CPA firm Hansen & Hansen. Before you start working, the firm requires that you participate in the first year staff training course. The instructor asks you to prepare answers for the following question. So how is audit evidence defined? All right, what type of information are we trying to collect detail on when we collect audit evidence? What was those two words that I said we are trying to test what? So remember, when the client creates the financial statements, there are certain implicit underlying situations that exist in those financial statements that relates to the people who created the financial statements. What is that body called, first of all? The people who create the financial statements. We were just talking about them, say they have a different responsibility from the auditor, the ones that run through the agents in the organization. Management, and management makes certain implicit underlying assumptions, which we call assertions. Yes, okay. So audit evidence is trying to test the assertions made by management regarding the financial statements. That is the goal of evidence. We are trying to collect evidence to test management's assertions. All right. So then you notice that it says, okay, well, how is the collection of audit evidence related to management assertions? Now, obviously, just said that that's the whole conjoined, but let's talk about this more in detail. And we're going to talk about one of the assertions. It's going to be a little bit more obvious than others. When we get to chapter 5, the assertions will become a lot more transparent, but let's deal with one right now. Let's say that I have a client that has one inventory item. Now, this is a very simplistic assumption. This is a very simplified assumption for very, very simple reasons. They've got one inventory item that's worth $1,000, and that's what's on their financial statements, okay? And when I say one, I'm not talking about one type. I'm talking about literally one inventory item, one piece of inventory that's worth $1,000. Remember that one of our assertions was existence occurrence, okay? Can I find a way to test whether or not that inventory item actually exists? Like, let's say you're the auditor, you're brand new and says, well, I've only taken the first two, I've only listened to the first two lectures in Dr. Barnes's course. I remember there's assertions, but I don't remember what they are. And I come to you as the audit senior, I say, I want you to test the existence of this inventory item. What would be the easiest way that you would go about doing that? Go look at it. Go find the inventory item, says, hey, there it is. Okay, there it is. It definitely exists. Okay. That's all there is to it, is that basically we are trying to find ways to test these assertions. Management's implying by having this on their balance sheet that this inventory item exists. We as auditors have to find ways to test that. So we're going to go find that inventory item and said, well, I see the inventory item, unless it's a hologram. It's not. Unless it's a really good hologram, it exists. Okay. And if it's a really good hologram, it probably is worth a lot more than the inventory item that's $1,000. Okay. There are other ways we could associate that too. So let's go ahead and flip it. I'm going to do the same inventory item, single inventory item that's worth $1,000 in the balance sheet. We've tested existence, but we also want to test valuation. Okay. They're saying this inventory item is valued at $1,000. Is there a way that I can test that to make sure that's relevant? There's a couple of different ways. I could go contact the vendor and say, hey, did you sell this to them for $1,000? And they say, yep, that's exactly right. Could I go look at the invoice and see that they paid $1,000 for this inventory item? Yes. All different ways and approaches to doing this. Again, the whole goal of this evidence is to try to actually reinforce these assertions that management made. What if they've got $1,000 inventory item and I go out there and I can't find inventory? I said, oh, they've got $1,000 inventory item, but where it's sitting, it's not here. And then I go and ask a warehouse worker and I say, where's this inventory? He says, oh, I've never seen it before in my life. Do we have a violation of an assertion there? Yes. All of a sudden, that existence issue that we've kind of taken for granted, that's no longer there. So it can work both ways. We can actually reinforce management assertions, or we can find problems with management assertions. So that's the whole goal. Then the final question is, what are the two key characteristics, and describe the meaning of these characteristics? These are actually related to accounting information. So accounting information, the conceptual framework says that you need to have evidence that's relevant and representationally faithful. We have a similar concept in auditing. We say relevant and reliable. But why are these why is it important? Why are these types of information important? So think about it this way. I'm concerned about the existence of that inventory item. Okay, I'm concerned about the existence of that inventory item. So to test it, I go and talk to management about their procedures for compiling inventory items. Does that actually prove the existence of the inventory item? No, management could be talking about something else entirely. So I'm gathering evidence, but is that evidence relevant to the assertion that I'm testing? No. When we gather evidence, we need to make sure that not only are we gathering evidence, but that the evidence that we have is testing the specific assertion we're concerned about. What about reliability? What about reliability? So I basically say, I need to test the existence of this inventory item. And somebody says, oh, here's a picture of this. And you see a grainy snapshot from 1932 of a picture of this inventory item, okay? Can we say that's a reliable piece of evidence? I think anything that's like nearly 100 years old, we could probably say that we don't really put a whole lot of reliance in that inventory. It could still be sitting in that warehouse covered in dust, okay? But this particular piece of evidence is not going to be what we would refer to as reliable. So we want evidence that's both reliable and relevant, because that actually is what's going to prove our effective testing of those management assertions. All right, with that, we are done for the week. Week 1 down, 15 more to go. I will see you all on Monday.